Hi guys, and welcome to video 9. In this video, I'm going to be talking to you about expected portfolio volatility, how to calculate it, and why it's important for you guys to understand it. In previous videos, we saw how to calculate both realized and implied volatility in various ways, and one of the core lessons from those videos was understanding that volatility should be assessed from both a risk and, more importantly, an opportunity perspective. And that's highlighted the importance of choosing assets and timeframes that give us enough opportunity to generate significant profits going forward. And we can extend that logic to the portfolio level as well. And we'll see that when we pick higher volatility assets to put in the portfolio, all else being equal, it does result in a higher portfolio volatility, which in turn obviously can translate to greater opportunities for profit as well. However, there are some important considerations that I want to go through with you guys when constructing a portfolio, which when understood and implemented, help increase your risk-reward ratio, meaning that you can obtain higher levels of return for a given level of risk. Throughout this video, I'm going to be explaining everything that you need to know about portfolio volatility, and I'm going to be doing that with the help of this spreadsheet that you can see on the screen now. You'll also be able to get this spreadsheet as a supplementary download file to this video so that you can look at it in your own time as well. But let me quickly explain what the sheets within this file actually are. The first one we have is an asset volatility summary. And that's a quick volatility summary of various equity assets showing both the realized and implied volatility calculations as of January 2021. And those volatility values are presented in the format of a standard deviation. There are two reasons really for using standard deviation volatility values in this summary table. And the first is so that the realized and implied numbers are comparable. And the second is because it represents the format that we're going to be calculating volatility in at the portfolio level as we go through the video. The second sheet here is a portfolio volatility theory sheet. I'm going to be using this sheet primarily to explain visually how portfolio volatility is affected based on individual asset volatilities and also their correlations with each other. The third sheet is called Portfolio Volatility Practice. This is where we're going to spend the majority of time in this video, and it's where I'll be going through practical examples of calculating portfolio volatility with real asset data. And then finally, we've got two sheets at the end here called Asset Returns and Asset Prices. And these sheets are just supporting data sheets which allow the calculations in all the other sheets to run. As the name suggests, these sheets basically just store prices and returns of various assets, the various assets that we see in this asset volatility summary on the front page. So now let me talk you through the steps that we're going to take in this video. In the first part of the video, we're going to be covering some basic portfolio volatility theory, which will give you a strong conceptual understanding of the different parameters that affect portfolio volatility and why they do so. That'll lead us into step 2, where I'm going to be implementing various practical portfolio volatility calculations. We'll be inputting different assets with different weightings together to see their effect on volatility at the portfolio level. And that's basically going to act as an extension to the knowledge learned already in the theory section. It's also going to provide you with some practical knowledge on how you can use the spreadsheet yourselves as well. And in the final stage of the video, we're going to cover some further practicalities of using the spreadsheet for your own portfolios, particularly in terms of downloading and importing your own underlying data. So with that out of the way, let me start by explaining some theory and defining what portfolio volatility actually is. Just like any asset, your portfolio has a value, and the variability in that value is known as its volatility, creating both risk and opportunity, as we've discussed previously. Now, when calculating realized portfolio volatility, that can actually be done in exactly the same way that we've looked at in previous videos for individual assets, i.e. you would record the value or price of the asset, or portfolio in this case, over time, calculate returns from that, and then calculate a standard deviation value from that time series of returns. However, when we're calculating expected portfolio volatility, that implies that we want some way of gauging an expectation of future volatility given certain inputs that we provide. And that has a number of benefits, such as allowing you to understand the expected risk and opportunity in a portfolio going forward. You can model volatility under different scenarios, such as adding or removing assets or changing portfolio weightings. You can target certain volatility levels, and it can help set reasonable portfolio stop levels as well. So there's a couple of ways you can calculate expected portfolio volatility, but the one that I'm going to show you guys uses historical asset prices to derive the inputs that we need for the calculation. And speaking of inputs, the three types of variables that we need to know for expected portfolio volatility are variances, covariances, and weightings for each asset in the portfolio. So let me explain those terms in a little bit more detail now. The weightings are simple. That's just the percentage of the portfolio that's allocated to the various assets that we choose to put in the portfolio. The variance of an asset is just a measure of volatility. Mathematically, it's just the standard deviation squared, so we can find that. And covariances measure the relationship between two assets. It's actually quite similar to correlation in that a positive covariance means that the asset tends to move in the same direction and vice versa. But in fact, correlation is just the normalized covariance, which means that it's bound between the values of 1 and -1, whereas covariance is unbounded. Basically, they both measure the relationship between two assets and how they move together or don't move together. So the covariances and variance values will be calculated based on historical prices, which will then be used as input estimates for future expected portfolio volatility. And that's important for you guys to realize that we're using past results to estimate future outputs. So now let's move on to the portfolio volatility equation. And you'll be glad to know at this point that I'm not going to go into any complicated maths here. I just want to outline how the equation works rather than teaching you the specific details of it. And basically, knowing how the equation works and what affects its output is going to be far more important to you guys anyway than being able to write out the equation yourselves. Now, as I said before, portfolio volatility depends on weightings, variances, and covariances of assets in the portfolio. And a typical way to look at variances and covariances is in what we call a variance-covariance matrix. And I've got an example of one here which I'll use to roughly explain how the portfolio volatility equation works. In this table, you can see various tickers for assets in a hypothetical portfolio in the row and column titles. That's these cells and these cells. And all of the numbers in the table represent estimates of covariance between the two assets in the representative row and column titles. So for example, the covariance between Facebook and Caterpillar is in this cell here, 0.0006. And you guys don't need to understand what that value kind of means specifically, why it's that number. Just know that it relates to the relationship between those two assets. And actually later in the video, we're going to be interpreting these relationships in terms of correlations rather than covariances, because it's a little easier to understand. So all of these numbers represent covariances between the assets in the related row and column. Now, in these highlighted cells, you'll see that there's numbers for a covariance between an asset and itself. For example, in the top left here, we have a covariance between Caterpillar and Caterpillar stock. Basically, what that represents is the variance for that asset rather than the covariance between that asset and another. So all of the orange cells going diagonally from top left to bottom right represent the variances for the individual assets. Another thing I want you to notice about this table is that you can see the numbers either side of the diagonal are actually symmetrical. And that's because if you take, for example, the covariance of Facebook and Caterpillar like we did here, being equal to 0.006, that is exactly the same as taking the covariance between Caterpillar and Facebook, basically. Just saying that the other way around. That is why it's symmetrical either side of this diagonal line. So how does this matrix help us understand the portfolio volatility equation? Put simply, portfolio volatility is calculated as a function of all the values in the variance-covariance matrix, as well as the weightings for each asset in the portfolio. And what this matrix tells us is that the larger the portfolio, the more important the covariance terms become to the overall portfolio volatility, certainly when compared to the individual variances of assets. And I'm going to demonstrate that now, just using a simple kind of example. So at the moment, if we assume that we have a portfolio that just contains one stock, let's say Caterpillar in this instance, the portfolio variance is just going to be equal to the variance for that individual asset. So the number that we could see in the top left cell of this matrix here. Let's then say that we want to add Facebook to the portfolio. What then happens is the portfolio variance becomes a function of the two covariance terms that we have between those two assets and the two variance terms that we have for those two assets. Again, if we add another stock, let's say PPL, you'll see that the portfolio variance then becomes a function of 6 covariance terms and 3 variance terms. Again, if we add yet another stock, Pegasystems, you'll see that portfolio variance now becomes a function of 12 covariance terms and 4 variance terms. So you can see that as stocks are added to the portfolio, the covariance terms start to outweigh the variance terms at an increasing speed. What that basically means is the relationships between assets start having much more of an impact on portfolio volatility than the volatility of the individual assets themselves. To demonstrate this further, I've built a chart up here which illustrates the principles that I've just talked about. And what this chart shows is how portfolio volatility, measured in terms of a standard deviation, changes with the number of assets in the portfolio. So we have standard deviation of the portfolio measured on the left-hand axis, on the y-axis, and then on the x-axis we have the number of assets in the portfolio. To make things simple, I've assumed that all assets in the model portfolios that we're going to look at have equal weightings, equal volatilities, and equal correlations. So it's definitely going to be some theoretical examples that we're going to go through, but hopefully they'll still enhance your understanding of the principles that I'm trying to get across to you guys. So each line in the chart represents a slightly different portfolio with slightly different asset volatility and correlation assumptions. And you can see that for every portfolio, there's a reduction in volatility as more assets are added, which always holds true provided that the new assets added aren't perfectly correlated with the rest of the portfolio, i.e. equal to 1. And just as a quick reminder about how correlation works, correlation measures the relationship between two variables. It ranges from 1 to -1, where 1 represents a perfectly positive correlation and -1 represents a perfectly negative correlation. For example, if we were to look at the correlation between the returns of two different assets, let's say asset A and asset B, on any given day, if asset A has a positive return, we would expect asset B to have a positive return as well if that pairwise correlation was equal to 1, i.e. they were perfectly positively correlated. And equally, if asset A had a negative return, asset B would also have a negative return. The inverse of that, i.e. a perfect negative correlation, is where asset A goes up and asset B goes down, or vice versa, and that always holds true. Obviously, a correlation of 0 means that there is no measurable relationship between the two variables that you're looking at. So back to the chart now. If we look at the intercept of these portfolios, of these lines, the y-intercept, that's where the volatility for each portfolio is highest, and that's when it only contains one asset. And as we saw before, in that case, the portfolio volatility is just equal to the volatility of that asset. From there, the slope of these lines, or the speed at which portfolio volatility then decreases as you add assets, is dependent on the correlations within the portfolio, the pairwise correlations between the assets in the portfolio. So if you take a look at the legend on the right-hand side of this chart, what you'll see is labels for each of the portfolios or lines within the chart that tell you what the correlation and asset volatility assumptions are within each portfolio. And if we take a look at the grey portfolio first, you'll see that we've got a correlation assumption of 60% between all of the assets and volatility assumptions for each individual asset within the portfolio of 25%. If we take a look at the line within the chart, obviously when we have one asset in the portfolio, the volatility of the portfolio is equal to 25%, which is equal to the individual asset volatility. And as you add more, the slope of that line is actually fairly shallow, and that's because of the relatively high correlation that we see in this portfolio being equal to 60%. And by the time you get to 6 or 7 positions added in this portfolio, the volatility of the portfolio actually barely changes at all beyond that, and that's due to that high correlation value. So that might be the kind of outcome that you get if you're, say, long only mega caps in the same sectors. Conversely, if you have a look at the orange portfolio, here we've assumed that the individual asset volatilities are a little higher at 35%, but the correlations are lower at 20%. And in that case, the portfolio volatility when there's only one asset in the portfolio equals 35%, so 10% higher than in the grey portfolio. But as more assets are added, the portfolio volatility actually goes lower than in the grey portfolio, and that's due to the lower value of correlation that we see in the orange portfolio. Basically, what we're kind of seeing there is the diversification effect of adding more assets being more efficient in the orange portfolio than in the grey portfolio. I've labelled that portfolio as an example of being long, short, large and mid-cap equities. In reality, in that kind of portfolio, the average correlation that you get might actually be even lower than that, and we'll see that later when we do a practical example. So the grey, orange and blue portfolios in this chart have fixed assumptions of correlations and asset volatility, but the yellow portfolio changes depending on the inputs that you enter into cells D3 and D4 up here. These values are entered in decimal formats, so a correlation of 0.2 means you're assuming pairwise correlations in the portfolio of 20%, and equally for annual volatility, a value of 0.45 means you're assuming volatility of 45% of all the individual assets in the portfolio. I've restricted the correlation cell to only accept values between 1 and 0. Although negative correlations within portfolios are possible, especially within a long-short portfolio, it requires a bit further explanation, and I don't really want to detract from the point that I'm trying to get across in terms of just low correlations and the diversification benefits of those. So you can play around with those values to get more of a feel for how they affect portfolio volatility. For example, I could put in here in the correlation cell D3 a value of 0.1. And then in the annual volatility, let's put something like 40%, so 0.4. And you'll see each time I do that, the chart changes, or the yellow line in particular, changes to represent what happens to portfolio volatility when assets are added to the portfolio, given the underlying assumptions that we've put into cells D3 and D4. So that's portfolio volatility theory out the way. I know I've used lots of new terms in this section of the video, but just as a recap, just remember that when I'm talking about variance and standard deviations, they are measures of volatility. And when I'm talking about covariances and correlations, they're measures of the relationship between two variables. And strictly speaking, we run all of the calculations for portfolio volatility in the format of a variance-covariance matrix, which I showed you earlier. And then we translate those to standard deviations and correlations because they're a lot easier for us to interpret. So hopefully by going through that variance-covariance matrix and looking at this chart as well, you guys understand a bit more about why correlations between assets are important and how they affect the volatility of the overall portfolio. And ultimately, what we're talking about here are the positive effects of diversification. But on that note, there's a very important practical point to do with diversification that I want to get across at this stage. You might be looking at this chart and thinking, okay, great. All I need to do is add loads and loads of assets and the risk return ratio in my portfolio is going to be really high because the volatility will be so small. Ultimately, and unfortunately, that isn't correct. In reality, what's going to happen is your portfolio returns are going to be driven by your high quality ideas, and over diversifying outside of those quality ideas is going to dilute those returns significantly. The problem with over-diversification is actually quite common in industry amongst professionals for various kind of structural and regulatory and liquidity reasons. But actually, as retail traders, we don't have any of those issues. So there's no excuse for you guys to be over-diversifying for the sake of it. And really, there should be a level of concentration in your portfolios that leads to significant returns. Even if we ignore over-diversifying's dilution effect on returns, there's also the fact that it becomes near impossible to continuously find low correlation ideas anyway. So beyond a certain point, it's going to be very difficult to reduce risk in that way. And typically, what you'll find is that good retail traders tend to have 8 to 12 high quality, high conviction and low correlation ideas that make up their portfolio. And that obviously depends a bit on the capital size as well. So with higher levels of capital, perhaps the portfolio size might expand into the low teens as well. Now we've covered the theory, let's move on to some practical analysis, and I want to start by explaining how this spreadsheet is set up a little bit further. We've covered the theory sheet. On the first page is the summary sheet, and that shows a table of various US equities, most of which you will have seen in previous videos, and they're classified by market cap. Inside that table, I've noted down measures of realized and implied volatility for the various assets over different frequencies, all in terms of their standard deviation value. So this sheet is really just here so that we have an understanding of the individual volatility of assets that might be used in portfolio scenario analysis, either in this video or when you download the spreadsheet yourselves. I should note here though that these volatility values were calculated on the 4th of January 2021. And the realized values were generated from all the available historical data at that date. And because of that, with some of the assets, you'll see there's a significant difference between their past volatility and their implied forward volatility. So for example, in the FANG stocks. And that's due to reasons such as these companies having been through long periods of growth and now maturing and diversifying their operations. I've talked about that in previous videos, so I don't really want to go into too much detail on that here. For all of the assets in the summary sheet, I've recorded their prices, and in the asset prices sheet, you'll see all of those, and you can easily get those from Yahoo Finance. We're going to look at that a little bit later in the video. The asset return sheet then generates returns from those prices. I've chosen to download prices and generate returns on a weekly basis simply because that's a time frame that I like to use to calculate correlations. I have my reasons for that, which I don't really want to go into here, but if you wanted, you can do the same with daily or monthly prices if you prefer. But it will also mean that you do need to change some calculation cells in the rest of the spreadsheet, so I recommend you just continue using weekly data. So as I said, the returns here are generated from the prices sheet, and they're used for variance and covariance equations in our portfolio volatility practice sheet that we're going to be moving on to very shortly. And an important point here is that all the different price and return data series must actually be the same length as each other, or the calculations in that practical sheet won't actually work. So in this case, you can see that I've got prices going back to the 22nd of July 2015. And on the return sheet, I've got returns going back to the 29th of July 2015. Remember that return calculations require the previous period's price within the formula, and so obviously the series for returns will be one period shorter than for prices. Later in the video, I'm going to go through an example of downloading your own price data so that you can model your own portfolio volatility and correlations as well. But before that, we're going to go through some scenarios with all of the data that I have in this sheet. So anyway, this leads us all to the main event, which is the portfolio volatility practice sheet. And this sheet's going to automatically calculate the expected portfolio volatility on an annualized basis for any portfolio that you build, as long as, of course, you have the supporting data in the sheets that I've just mentioned. It's a very useful tool in terms of scenario analysis and also understanding your portfolio volatility and the correlations within that portfolio. So at the top of the portfolio volatility practice sheet, you'll see what we call a variance covariance table or matrix, which we've already been through in the theory section of the video. This one can support up to 25 positions, so you can insert any company that you have the data for into the portfolio by typing the ticker into these orange cells on the left here. And on the right hand side, you can also choose the amount of capital committed to each of these positions, and I'll talk more about that as we go through some examples. In this sheet, something to remember for you guys is that the only cells that you should really be editing are the orange cells. There's actually a lot of complex formulas that we've got going on in different cells within this sheet, so I think it's likely that you'll run into trouble if you try to edit some of those. So I strongly advise just editing the orange cells within this sheet. So the values in this top matrix are used to generate a portfolio variance number in the table below, and that variance is then converted to a standard deviation value, which will represent the expected portfolio standard deviation for the same time frame as your prices and returns represent. So in this case, weekly. Finally, that value, so that weekly value in this case, is turned into an annualized figure in cell C43. So if you were to change the frequency of the data in your price and return series to something other than weekly, so daily or monthly, for example, then you're going to have to change a few formulas in this box here. But like I said before, I advise just downloading the data on a weekly basis for this task, and then everything should work smoothly. So in this box, I've also put an average asset volatility calculation, and that's just based on all the assets that are in the portfolio, and really I've just included that as a useful reference. Adjacent to this box is what I've called a scenario analysis table, which I'm going to comment on later as well. And then below that, we've got another matrix table which shows pairwise correlations between assets that you've entered in the portfolio. And again, that's something that I'm going to talk about in more detail as we go through some examples. So let's start with our first scenario now. Currently, you can see in the portfolio that we are long $10,000 each of the FANG stocks and Microsoft. And in this first scenario, what I want to go through is basically building out this portfolio to a 10-stock portfolio of mega caps where we're long only. So if we go back to the summary page, this is all the stocks that we can currently choose from as the spreadsheet stands. We need 4 more mega caps, so I'm going to pick Visa, Disney, Nike, and Caterpillar. Now you can either copy these tickers you want and paste them as values into the orange cells in the portfolio volatility practice sheet, or you can write those tickers in manually into those orange cells as well. So those tickers are V, and then DIS for Disney, NKE for Nike, and CAT for Caterpillar. So for every ticker entered, you've got to give it a dollar allocation as well. So for each of those assets, I'm going to give a $10,000 allocation to them, just so that all the assets in the portfolio are equally weighted. So what you will have seen there is, as I added those tickers into these orange cells over here on the left-hand side, this covariance and variance matrix started filling out with more values because it was adding those tickers into that matrix. And if you looked closely at this portfolio variance and volatility table down here, when we added those tickers, it actually resulted in error values within these calculations. And it was only once we added a dollar allocation to each of those tickers that all of these calculations actually started working. So I just want to point out at this stage really that when you add tickers to the portfolio, you need to make sure that you're also adding dollar allocations as well. Otherwise, these formulas won't work. I also want to talk briefly now about the mechanics of adding, removing, and replacing assets in the portfolio. So when you enter tickers into the orange cells on the left-hand side, the calculations are only going to work if you have an unbroken list starting from cell B9 and going downwards. So for adding an asset, what that means is you need to make sure that the ticker you enter is in the cell immediately below the list of tickers that you already have. So in this case, that would be in cell B19, not B20 or B21 or so on. And you obviously, of course, need to make sure that you enter a dollar allocation for every ticker that you have as well. And when it comes to removing assets, you need to delete the ticker and, of course, the allocation to go with it, and then shuffle the tickers and allocations below upwards so that there are no gaps in these cells. So what I mean by that is if you were to delete, say, Visa in this portfolio, you would press delete on that cell and delete for that allocation as well. And then you'd need to copy these tickers upwards and the allocations upwards as well. So I'll just do that now quickly to show you. I'm just copying and pasting as values for these cells. And then obviously deleting the bottom one because we've got a duplicate of Caterpillar. So basically that maintains this unbroken list of tickers and allocations running downwards from B9. I'm just going to go back a few steps in the portfolio so we get Visa back. I'm just pressing Ctrl Z to undo the actions that I've just done in Excel. Okay, so we're back to what we had before now. Equally, as well as for removing assets, when you replace assets, you need to delete the appropriate ticker, like I just did, say for Visa, and replace it with a new ticker. And you can obviously do that in place of the one that you've removed, so long as it continues to create that unbroken list of tickers from cell B9 downwards, and in the allocation column from cell AB9 and downwards. So what we've got here is essentially a very simple, equally weighted, long-only mega cap portfolio. And you can see from cell B43 down here that the annualized portfolio volatility or expected portfolio volatility is calculated as 19.52%. Now, remember, this was just generated using the past data that we've chosen. So from mid-2015 to the end of 2020, all the data that we see in the asset prices and asset returns sheets. So it's just an estimation, basically. And it's only going to hold true if the variances and covariances of all the individual assets remained constant. Now, obviously, that isn't going to happen, but that doesn't mean that it's not a decent estimate for our expectations going forward. So if we scroll down to the bottom of the spreadsheet now, we can have a look at our correlation matrix as well. And at the moment, this doesn't actually represent our whole portfolio because we haven't put in the new tickers yet. And you can see that there's small warning icons down here, which tell us that the tickers in this correlation matrix don't match the tickers in the covariance variance matrix above. So to rectify that, we would just put in the tickers in the right order within these cells. I'm going to do that by copying those new tickers, so from Visa to Disney, Nike and Caterpillar, selecting those, pressing Ctrl C to copy, then I'm going to right click in cell B55 and paste those as values into those cells. And then a bit like in the table above as well, to finish things off here, we've got to make sure that we're telling the correlation matrix whether we are long or short these tickers. In this case, 1 means long and -1 means short. So in all of these cells here, in column AB, we've got a little drop down menu where you just select between 1 and -1 for each one. So I'm just going to select 1 for all of these because at the moment in this scenario, we are just long only everything. So that's going to make sure that the correlation matrix knows that we're long all of these tickers here. And you can see now that I've entered Visa, Disney, Nike and Caterpillar. All the match icons have green ticks in them in those cells. So we know that it's matching the variance covariance matrix above. So as I explained earlier, the correlation matrix tells us the pairwise correlations of each of these assets in the portfolio to each other over the time period that we've got data for. So you can therefore see which assets have a relatively high or low correlation in the portfolio by looking through those cells. I've also tried to make things a bit easier in terms of identifying high and low correlation assets by taking an average of the pairwise correlations for each asset to the rest of the portfolio. So for example, we can see that Facebook has an average correlation of 48.94%. You can see that in the top row of the correlation matrix in the average correlation cell here, AC49. And as well as all of these average correlations for each asset, I've also calculated an average correlation across the whole portfolio, which you can see in cell AC73 as well. So why is all of this useful? Well, remember what I said earlier about correlations in the portfolio contributing significantly to overall volatility. This table basically just allows you to eyeball and compare various different assets and portfolios as a whole and judge their risk based on values of correlation. So it can be useful for aiding scenario analysis to see how different weightings and different assets affect the overall portfolio volatility, for example. With that being said, let me go through some practical examples of how you might use this correlation matrix. So let's say that you want to add Oracle, another mega cap stock, to this portfolio, but we're concerned that it might be highly correlated with the assets that we already have in the portfolio, and we don't want to expose ourselves too much to the same type of risk, which we might identify by looking at correlations between this new asset and the ones already in the portfolio. So we might first enter the ticker into the correlation matrix to understand how it correlates with the assets we already have. So if we do that with Oracle, I will put Oracle or ORCL into this cell here, and then make sure the exposure is set to long. So just putting a 1 in this cell here to show that it's a long position. And when I do that, you see that in general, Oracle seems to have a lower average correlation to the portfolio than many of the other assets. So in terms of high correlations, there's definitely no red flags here. And you'll see that if we add this asset to the portfolio covariance variance matrix, it results in a lower overall portfolio volatility than we had previously. So you can see here I'm putting in Oracle ORCL with a dollar allocation of 10,000, just so that everything remains equally weighted for now. And you'll see here that the portfolio standard deviation has gone a little bit lower. Another scenario that you might come across is where you need to remove an asset from the portfolio to free up capital. And let's say in this example, we're considering removing either Nike or Microsoft from the portfolio. If we take a look at the volatility summary page, you might conclude that if we removed Nike, then our portfolio volatility should be pretty similar to if we removed Microsoft, since they've got very similar individual volatilities on both a realized and an implied basis. But if we take a look at the average correlations that we have for these assets, then you'll see that Microsoft has a much higher average correlation of 57.08% versus Nike's 36.85%. So actually, what we would expect is that the portfolio without Microsoft would have a lower volatility than one without Nike. So let's test that now. So there's basically two ways that we can go about testing this. The first is, as I showed you earlier, where you can delete the tickers and their relevant allocation and then shuffle all of the other tickers upwards in this variance covariance matrix. So we would do that first for Microsoft, check the portfolio volatility without Microsoft, then add it back and do the same for Nike to check the portfolio volatility without Nike and compare the two values. Now, obviously, that's a little bit of a laborious way to go about this task. There is another way that I'm going to show you now, just for kind of modeling what removing an asset would look like for these calculations. So what we can do is actually just set the allocation for the asset that we want to move to 0. So if we do that first for Microsoft, I click in this cell and just change it to a 0, then you'll see what happens to the overall portfolio standard deviation in a moment. So when we remove Microsoft, it doesn't really change too much at all. If I add that back in, so I'm just going to type 10,000 back into the Microsoft allocation, and then take away Nike by putting in 0 into the Nike allocation, you'll see that portfolio volatility actually goes up a bit. And that's what we were expecting, really, because the correlation for Nike to the rest of the portfolio was on average lower than for Microsoft. So removing Nike from the portfolio has more of a detrimental effect in terms of diversification, i.e. the portfolio volatility has increased more than it would have done just by removing Microsoft. So that's that out the way. Now, I'm not saying by going through these couple of examples that I've just gone through that you should be adding or removing assets purely based on correlations. There's much more important factors that come first, not least looking at a trade's fundamentals, and if fundamental reasons have changed, then that would be the primary motivation for adding or removing assets, or even changing weightings. But it is just something else to consider, and it might highlight risks in the portfolio that you wouldn't otherwise have seen. So we've got sidetracked a bit there with looking at correlations and me going through examples of how you can use this correlation matrix. Let's get back to the scenario that we were looking at originally, where we were looking at a 10-stock long-only portfolio of mega caps. So I'm going to remove Oracle from both the variance-covariance matrix and also the correlation matrix below. So when I do that, let's just take note of what the portfolio volatility is. It's 19.52%. Also, we can see that the average portfolio correlation is around 46.67%. And just before we go on to the other scenarios as well, we'll take note of the fact that our average asset standard deviation in the portfolio is 27.93%. And that's just going to serve as a bit of a reference point for us looking at other scenarios in a minute. So let's compare that first scenario there with another one now. And this time we're going to look at, again, a 10 asset portfolio that is long only. But this time will be long, large and mid caps instead of mega caps. So for this example, I'm going to pick 5 random large caps, 5 random mid caps from the asset volatility summary page. And I'm going to pick STZ, PPL, LVS, LEN, LUV, PEGA, OLED, TREX, MOS, and DKS. So if I copy all of these as values into the variance-covariance matrix and give them all $10,000 allocations, which they already have here because of the previous setup that we had in this matrix, then you can see if we keep all of those equally weighted, then what you get is a portfolio volatility value of 27.35%, which is higher than the previous portfolio, and that's what you'd expect given the fact that our average individual asset volatility is now 40.75%. So let's have a look at the correlation matrix now for this portfolio. And if we scroll down here, you'll see that there's a lot of warning signs in column A showing that the tickers currently in this covariance, or rather in this correlation matrix, don't match the variance covariance matrix tickers that we just put in. That's because they've still got all the mega cap tickers from the previous portfolio. So we need to copy and paste those tickers that we have in the variance covariance matrix for the new portfolio down to this correlation matrix, like just like I did previously, by copying and pasting as values. We don't need to worry too much about changing the long or short cells because we're still long only, so they've all got a 1 assigned to those cells. And what you can see here is that despite the higher average asset standard deviation in the portfolio compared to the previous portfolio that we had of mega caps, we actually have a lower correlation, or a lower average correlation, which is now 40.14% compared to the previous portfolio that had an average correlation amongst all of its assets of 46.67%. So the conclusion here is similar to that which we've drawn previously in other volatility assessments, and that is just that there is more volatility in trading large and mid caps compared to just trading mega caps. And that's good for us because whilst it does represent additional risk, it also means that there's more opportunity for profit as well. What's also highlighted in this example is that generally you're going to get diversification benefits that are greater when trading small and large caps rather than mega caps. And that's because the universe of small and large caps is obviously a lot larger than it is for mega caps. So there's a lot more choice and obviously a lot more exposure in terms of risk. So not only do you get to take advantage of the higher volatility in individual assets, but you're also going to likely have lower correlations across those assets, which is going to result in better risk-reward profiles in your portfolios as well. So our next scenario is going to look at a portfolio example that's a bit more representative of the kind that ITPM traders would put on, and that's because it's going to include longs and shorts. So we're going to stick with the same portfolio in terms of assets, but instead of being long everything, let's assume that we want to be short our large caps and long the mid caps. And to make a position short in the variance covariance matrix, you just need to turn the dollar allocation negative. So in this example, I still want to keep everything weighted the same in gross terms. So all I'm going to do is replace these $10,000 values with minus $10,000 for the top 5 stocks. So the large cap stocks that you see in this portfolio. Once I've done that, you can see that it's made a massive difference to the portfolio volatility, which is now 10.83% instead of 27.35% that we had previously. The individual asset volatilities are all the same, and so all of that change in overall portfolio volatility has to be to do with correlations and covariances. So let's have a look at the correlation matrix now. To analyze our correlations, we're going to need to make sure that we have the correct number in the long-short column. And remember that we've gone short our large cap, so we need to make these top 5 values here have a -1 value in those cells. So if we change those now, you can see that around half of the pairwise correlations have actually turned negative in this matrix, which is unsurprising given half the positions that we have on are shorts and half are longs. But that basically results in a much lower average correlation across the portfolio. And you can see why that's drastically decreased the overall portfolio volatility. So you might be thinking at this stage, given what we've taught so far, that if volatility drops off that much by being both long and short, aren't we forgoing opportunity for profit? And the answer is no, not exactly. That's for several reasons. Firstly, this is a strategy for all markets where we're targeting absolute returns every year, irrelevant of what happens to the broader market. So sure, it might mean occasionally you return less than the market, but you also won't lose as much as the market does. And over time, that's going to mean that you actually outperform the market significantly. If you need proof of that, just work out what percentage you need to gain to break even after you've lost 20%. And I'll give you a hint here. The answer isn't 20%, it's actually more. Secondly, remember the data that we're looking at is all based on a large period in history. So in this example, from 2015 to 2020. And it tells us what's been true on average in that past period. So whereas historically a long and a short position that you're looking at might be negatively correlated, when you're generating and timing ideas, you're going to have a positive return expectation on both the long and short sides of your portfolio over the period that you're trading those assets. So if you're right, obviously the returns can be massive. And if you're wrong, typically you're only going to be wrong on either the long or the short side, meaning that your downside will be somewhat reduced. And of course, it is possible that you could be wrong on both sides, and that isn't going to be pretty. But if you do your homework with what we teach in the Professional Trading Masterclass course and practice implementing that knowledge with real money, then that's going to be much less likely than it would otherwise. Thirdly, and perhaps most importantly, many of you will be using options to implement your ideas, and options have implicit leverage embedded in them, given that they cost a fraction of the price compared to buying or selling the underlying stock for a similar amount of exposure. By trading options, you can also control the amount of leverage that you take through your allocation of capital to those options premiums. And for example, you might have up to 5 to 10 times the volatility you would with the underlying portfolio for the same amount of capital committed when you're trading options, which obviously increases your opportunity for profit massively. And that doesn't necessarily translate into a downside that's magnified proportionally either, since options are structured in such a way that downside is limited to premium paid. So we can take advantage of this asymmetric risk profile as well. So options are a really interesting way to structure your trade ideas. And unfortunately, it's beyond the scope of this video to talk about that in more detail and how you would use options in your portfolio. But all of that is covered in the Professional Options Trading Masterclass video series. What I will talk you briefly through though is how options work in terms of leverage with an example. So let's consider Pegasystems stock as an example. In our portfolio above, we're assuming a long position to the value of $10,000. And Pegasystems trades currently at this time around $135. So if you bought the stock, you would get around 74 shares with your $10,000. And let's say you have a price target of $160 within the next 3 months. If you're right, you would make $25 times 74, which equals $1,850. Let's compare that now with buying call options on Pegasystems. So this is a screenshot taken from NASDAQ on the 12th of January, and it basically shows a small options chain for Pegasystems for the 19th of March expiry. It looks like the 135 strike can be bought for around $10. And when you buy an options contract for a US stock, it covers 100 shares of the underlying stock. So in this case, it's nice and simple. For $10,000, you could buy 10 of these call contracts. And with that structure, if you're right on your view that Pegasystems will reach $160 within 3 months or expiry of the option, then you would make around $15,000. The way that works is the options premium accounts for $10,000. The options profit is the difference between the ending price of Pegasystems, so $160, minus the strike price $135 times 1,000, which is 10 contracts times 100 shares, minus the premium paid of $10,000 for all of those contracts. So that equates to $15,000. So that's a really simple and crude way to explain how there's implicit leverage when trading options. And in that example, buying the stock outright gave you exposure to 74 shares of Pegasystems, but by buying call options, we had exposure to 1,000 shares of Pegasystems for the same cost. And granted, there are caveats to this, such as the break-even for profit being $10 higher and an expiry on the contracts, but there are ways that you can manage these risks through idea generation and more sophisticated option structures that are mentioned in our other courses. Don't forget as well that you can obviously control the leverage you take by reducing the premium you spend and exposing yourself to less contracts. So it does give you that added flexibility, and your maximum downside is limited to the cost of the options, whereas your upside for call options is unbounded. So you can benefit from a very asymmetric payoff profile as well. So typically, a good trader might get around 60% of their trades right, 40% wrong. Let's say that in a given year, around 90 to 95% of their trades might sum up to a small profit. And then there's going to be this 5 or 10% of trades that equate to home runs with this kind of strategy. And they're going to generate the vast majority of end of year profit. And on the subject of good traders, actually, I have a little scenario analysis table in this spreadsheet, which essentially shows you what sort of return you might expect for varying levels of Sharpe ratio, given the modeled volatility that we see in the portfolio at the moment. So the gross Sharpe ratio is essentially just the annualized portfolio return divided by an annualized volatility. And the higher the number, obviously, the better. So it's a risk-adjusted return measure for trader performance. And very good retail traders should expect to have a gross Sharpe ratio of around 1.5 to 2. And you can see in the portfolio here that we've set up currently that would basically equate to a 15 to 20% portfolio return on an annualized basis. But remember that that's likely to be magnified if you're trading options or using leverage in other forms. And what that means is, a well-traded long-short portfolio using a structured approach with quality ideas might make more like 75 to 100% in a very good year of trading. Bear in mind though that that's only really going to be achievable with the right education and obviously plenty of practice with real money trading as well. So let's go back to our spreadsheet now for another scenario. This is going to be our last one, and it's a very simple one. I just want to show you guys how and why you might change your weightings around in the portfolio. Firstly, I want to point out that obviously you don't have to equal weight every asset in the portfolio. You can change these allocations to any numbers you like, and the spreadsheet calculations will still work. And realistically, it's going to be very unlikely that you'll have equal weightings in the portfolio, because even if you wanted to allocate $10,000 to each trade, as in this example, unless the share price or options price is a divisor of $10,000, then your actual allocation will be slightly different. And also, bear in mind that prices of the assets will move as well, so the effective allocation or exposure to those assets will change as time goes by. So you might want to periodically update your allocation cells as time goes by if you're using this sheet to gauge your portfolio's current expected portfolio volatility. You'll also need to bear in mind that your conviction across ideas will vary as well, and that should be reflected in the allocations to each of the trade ideas. So sometimes you might put on a half position, sometimes a full position. And again, that isn't something that I'm going to discuss in too much detail here, but it is something that we cover in the Professional Trading Masterclass course. It's likely as well that your view on the overall market will influence how many dollars you allocate to long positions as a whole compared to your short positions. Let's say in this portfolio here, for example, that we're actually bullish on the market in general. And so we might want to make sure that we have a long exposure in terms of our net dollar allocations. By the way, that isn't actually necessarily what you should do if you have that view. There's actually quite a few more factors that decision would depend on, rather than just committing more dollars to the long side of your trades than to the short side. But anyway, assuming that we want to keep our long ideas equally weighted to each other and our short ideas equally weighted to each other, we could just reallocate the same amount from each short to each long in this example. So if we were to take $1,000 off each of our shorts and put them into our longs, then effectively the long side of the portfolio would be equally weighted and the short side would also be equally weighted with each other. So as you can see here, once we've done that, we still have the same gross exposure here, but the tilt into long positions has resulted in an increased portfolio volatility, which is expected since we're now actually less evenly diversified and we have a higher concentration in our long positions. So those are just some examples of how you might want to change the weightings and why you might want to change them for each asset and how you go about it. That's all I really wanted to cover in terms of the scenarios and scenario analysis in general for this spreadsheet. So all that's left now in this video is for me to show you some of the practicalities of updating and using the sheet for your own portfolios. Now, when it comes to you guys using this spreadsheet, my suggestion for you is that you use it as it stands to get used to the mechanics of how it works and what you can do with it. And then once you're ready, you start making changes to the underlying data to start reflecting your own watch lists and portfolios. So with that being said, let me talk about how you would do that. Firstly, you want to delete all the tickers and data in the prices sheet because you won't need that when you update it with your own prices. Second, you'll want to download new weekly price data from Yahoo Finance or another source. For the stocks that you want to be able to model portfolio volatility and correlations for. And then finally, you'll need to make sure that the data that you've now got in the asset prices sheet and asset return sheets are cleaned and manipulated to make sure that the time series of prices and returns are equal and over the exact same time intervals for all of the assets. And only then will all of that data be ready for analysis in the other sheet, so in the portfolio volatility practice sheet. So I'm going to go through a practical demonstration of how you would do that now. And we're going to start by going over to the asset prices sheet and just deleting all of the data that we see in this sheet from column C across to column AK. So basically all the price data and the dates data that we have in there, I've just selected all of those columns so that all the cells are highlighted. Then I'm pressing delete on the keyboard to delete all of that data. Next, what we want to do is download new asset price data for the assets that you want to include or be able to model in your portfolio. So in this short example that I'm going to go through, we're just going to grab data for PayPal, Autodesk and American Airlines, and I'm going to grab that data using Yahoo Finance. And I will be going through this practical demonstration pretty quickly because the mechanics of all the processes that we're going to use to download data from Yahoo Finance and put it in the spreadsheet, it's all stuff that you've done before in previous videos, so I don't need to explain it again, but you will obviously be able to see what I'm doing quite easily just by following the video. So as I said, the first thing that we need to do here is download some data, some price data from Yahoo Finance, and I'm going to do that for PayPal stock first. So I'm going onto my web browser to Yahoo Finance, typing in the ticker for PayPal, navigating to the PayPal homepage, and then going to historical data and changing the parameters to the ones that we want. So we want to see all the possible data going back throughout history for PayPal, and we want to see that price data on a weekly basis. And then I'm going to click apply and download. As usual, that gives me a shortcut to open that file at the bottom of my Google Chrome browser. It might be slightly different for you guys, but you just open the downloaded file. And then we have all the price data for PayPal on a weekly basis. The first thing I want to do here is sort the dates to a descending order rather than ascending order. So I'm going to click on cell A1 here, go to data on the ribbon, and then click filter, and then click on the filter in cell A1 and sort from newest to oldest. We then want to grab the date column and the adjusted close column to copy and paste into our portfolio volatility spreadsheet. But before I do that, I've noticed here that the top row of price data isn't a full week of price data, so I'm going to delete that first. So I've left clicked on row 2 here, right clicked in that selection and gone to delete. That'll delete that row. Now I can select columns A and F, the date and adjusted close columns, and press Ctrl+C to copy those, and then paste them into columns C and D in the asset prices sheet of our portfolio volatility spreadsheet. We don't need the cell C1 to contain a column title for date, so I'm just going to delete that. We do need a column title in cell D1, which is for the prices that we've just downloaded. So those are obviously PayPal adjusted close prices. So I'm just going to make the column title PYPL. You need to make sure that you're consistent with the column titles. Just make them the tickers of the companies. That'll make sure that the rest of the spreadsheet works as it should. So that's PayPal prices done. If we then cast our eye over to asset returns, the asset return sheet, you'll see that we've still got all of our old stale data here, and it's resulted in a load of error values because the returns can't be calculated anymore because we don't have the prices for all of these stocks. So what you do first here is delete all of that stale data. So in this case, I'm going to delete from columns E across to columns AK. And that gets rid of all of the error values. I've kept column D because that's actually referencing the prices that we have in column D of prices. So that is actually the returns for PayPal. We just haven't renamed the column title yet. At the moment it's V for Visa. We need to overwrite that with PYPL for PayPal. And if you just take a quick look at how this return sheet works, basically it references various cells in the prices sheet. So for dates, it's just referencing cell C2 in cell C2 of return. So it's copying whatever date it sees in the same cell, basically, in the asset prices sheet, and doing that all the way down column C. For column D, it's just taking basically the current price divided by the previous price minus 1, which is another mathematical way to get to the same arithmetic return as we've calculated in previous videos. So for example, in cell D2 here, it's taking the price that it sees in the asset prices sheet in cell D2 divided by the price that it sees in D3 minus 1. So this cell divided by this cell minus 1. So all our returns are automatically calculated here. What we do need to do is just make sure that this time series is the same length, or the right length, compared to that which we see in asset prices. So at the moment, if I go down to the bottom of the sheet here, or the bottom of this time series, it's going back to the 10th of August 2015. If I check what the length is of the PayPal price data column, then I'll see that it goes back to the 6th of July 2015. So it's slightly longer, goes to row 290. These asset returns go to 285. That's just because that was the common length of time series for all the previous tickers that we had in the prices and returns sheet. So I'm going to extend these formulas down a few rows to 290, which will make it the same length as that which we see in the prices sheet. And you'll see there that we then have an error in the final returns cell. That's obviously because it can't reference prices before, in a date before that date of the 6th of July. So we just delete that last row. So basically our returns are always going to be one row shorter than our prices. So our returns are going down to 289 at the moment, row 289. Our price is going down to 290. So that's PayPal done. Let's move back to Yahoo Finance, and we can download data for the next stock, which will be Autodesk. So I'm going to go back to Yahoo Finance now, type in the ticker for Autodesk, which is ADSK, select the right company from the drop down. You can see it's already loaded us into the Autodesk page here. We can just make sure we reselect the maximum time period, because that'll change now because we've got a new company in this page. We can keep frequency the same and then click apply and download. That'll download prices for Autodesk. We're going to go through the very same process that we did with PayPal. So cell A1, I'm going to click in that, go to data on the ribbon, filter, and sort all of these dates from newest to oldest rather than oldest to newest. Again, we need to delete row 2 because that isn't a full week of data. And then we just copy column A and column F, the date and adjusted close columns. Actually, sorry, we don't need to copy the date column in anymore because those dates will already match that which we see for PayPal. Just check that whenever you download new data, but that should be the case in Yahoo Finance. So we can just copy column F, the adjusted close prices for Autodesk, into our portfolio volatility spreadsheet, into the asset prices sheet, and into column E here. And then we just rename the column heading, so cell E1, to the ticker for that stock, so ADSK. And the next thing we want to do is just double check that this time series of prices is the same length as PayPal. I think what we see here is that it's actually a lot longer. So you can see that Autodesk prices go all the way back to row 1857. Now, for the purposes of this spreadsheet, we need to make sure that all of our prices and returns columns are the same length. And obviously that means in this case, we can't take advantage of all this older data that we have for Autodesk. So I'm just going to delete all of the data that we see beyond row 290. So from row 291 and down. So we delete all of that Autodesk price data. And then we've got two price series that are the same length. That's all good. Let's go to our asset return sheet now and go to the top of the sheet. We can type in our new column heading for our new ticker for our new company, which is the ticker ADSK. And then we can just copy across this formula in cell D2 to cell E2 by clicking and dragging on that little box in the bottom right of the cell selection to the right hand side. That's then just going to reference the prices in column E instead of column D for that same row, which is perfect because that's where our Autodesk prices are. And then we can just copy that down by double clicking this little green box in the bottom right of this cell selection, cell E2. That'll copy the returns all the way down to the end of the return series for PayPal. That's great. So we've got 2 return series at the same length as well now. So let's finally move on to our last company. So we're going to download prices for American Airlines now. So I'm back in Yahoo Finance. We're going to type in the ticker at the top for American Airlines, which I believe is AAL. Okay, we can click the company from the drop-down menu there. It loads American Airlines into this page. Remember, we need to reselect the maximum time period for this stock. And you can see that this time it goes from 2005. We keep the frequency of data as weekly, click apply and press download. So we've got American Airlines price data back to 2005 now in this new sheet that I've just downloaded and opened. Again, we're going to reorder the dates. So I'm clicking on cell A1, going to data on the ribbon, then filter, then clicking on the filter in cell A1 and sorting by newest to oldest. Again, we need to delete that top row of price data because it doesn't represent a full week. And then we just copy the adjusted close prices for American Airlines from column F in this sheet to column F into this, column F into the asset prices sheet of our portfolio volatility spreadsheet. We rename the column title to something appropriate, so it will be the ticker for that company, AAL, and check the length of the time series. We already know it's actually going to go back to 2005, but that's going to be too long. So if we go down to the bottom of the price series that we already have for PayPal and Autodesk, and then select from row 291 onwards for our American Airlines prices, we can just delete all of that data so that we now have a common length of asset prices in terms of the time series of asset prices for these 3 stocks. That's exactly what we want. So we can go to the asset return sheet now. In a similar way to that which we did for Autodesk, we copy this formula across to column F now and down to the bottom of the sheet and rename the column title to the ticker of the stock that we're looking at, so AAL. So there we have it. We've downloaded price data for 3 new assets that we want to model portfolio volatility for and also check out correlations for. And we've converted those prices to returns. We've made sure that we've manipulated all of that data so that they all have a common length of time series in both returns and prices. That's very important in order to make the rest of the sheet work, the rest of the calculations work in the portfolio volatility practice sheet. So we started with PayPal, which had a relatively short time series, and Autodesk had a longer one, so we had to delete older data, and the same with American Airlines. So what you might actually have is when you guys do it yourselves is you start with a longer time series and then import a shorter time series. If that happens, obviously you just delete the dates and returns or prices for the longer time series as well. So basically, just make sure that you end up with time series that look like this, where the date column and all the returns or prices columns look exactly the same in terms of their length. So now we've been through that, we can just very briefly check out that all of this data actually pulls through, and I can show you that it works. If we go over to the portfolio volatility practice sheet now, you'll see that currently it's got a load of errors in because it's trying to reference tickers that no longer exist in our asset returns and asset prices sheets. So we need to delete all of those. So I've got them selected here. We can just delete those and delete all of the allocations that go with them. And then we can just type in our new tickers for the assets that we've downloaded price data for. So we have PYPL, we have ADSK, and we have AAL. So PayPal, Autodesk, and American Airlines. You can see that all the variance and covariance calculations are working automatically as we type those in because we have all the data in the background for those. Remember, to get these portfolio variance and volatility calculations to work, you need to make sure that you have allocations for all of the tickers that you enter in. So I'm going to keep things simple here and just put in a $10,000 allocation to each of these stocks. And you'll see once I do that, we have a portfolio variance and portfolio standard deviation calculation that's working. So that's all there is to it really in terms of downloading and inputting new data so that you can model portfolio volatility yourselves. I'm not going to go into any more detail than this or expand it into any more stocks because I think you guys will get the idea. And I just wanted to show you that all of the data actually feeds through and works when it comes to the calculations in this portfolio volatility practice sheet. So to conclude this video, let's have a quick recap of what we've been through. In the first section, we talked about the theory behind the portfolio volatility calculation, and we highlighted the parameters of the equation. That's the weightings, the variances and covariances of individual assets in the portfolio. And although a portfolio's variance is a function of those variances and covariances of the individual assets, we found that as more assets are added to the portfolio, it's the covariance terms that become the dominant contributors to the eventual output of portfolio volatility. And we learned then that the relationship between assets, whether it's measured in terms of covariance or correlation, is the most important factor in diversification within a portfolio. But with that being said, there are two things to consider at this point from a practical perspective. The first is that it would be naive to assume that historical correlations always imply future correlations. So there may be events in the future that cause correlations to change, even if only temporarily. And a good example of that would be a liquidity crisis when correlations tend to 1 as there's this sort of dash for cash across assets and asset classes. The second is that even in the unrealistic scenario where we assume we can find endless numbers of low correlation assets to add to a portfolio, we still need to be cognizant of the opportunity or profit side of the equation. And what I mean by that is that over diversification tends to lead to executing lower quality and lower conviction ideas, and that can seriously damage future returns. So there still needs to be this a certain amount of concentration of positions to maximize returns whilst taking advantage of low correlations where possible. In the second section of the video, we illustrated some of the theoretical concepts that I just mentioned through a number of scenarios. So in the first two scenarios, we saw that not only does trading small cap stocks give us much more opportunity for profit compared to mega cap stocks, but it also likely results in lower correlations throughout the portfolio due to the greater opportunity set that small caps represent. And then the third scenario we went through represented a typical type of portfolio that an ITPM trader might hold, which was one that was both long and short small caps and large cap stocks. And by being both long and short these various assets, the average portfolio correlation that we saw was much, much lower, as was the overall portfolio volatility. So both of those reduced significantly. And despite that reduction in volatility, as I mentioned earlier, that doesn't necessarily mean that there's less opportunity for profit. And that's for a number of reasons. The key ones that I mentioned earlier being that having a long-short portfolio is a strategy that can work in all markets. And also that you can increase your upside significantly just by structuring your trades with leverage products such as options. Now, structuring portfolios with options to obtain better risk-reward dynamics is something we cover more of in our professional options trading masterclass course. But what it essentially means is that whilst you might model a small and large cap long-short portfolio as having, say, 10 to 15% annualized volatility, as we did in scenario 3, once you account for the implicit leverage in options, the actual volatility could be substantially higher if the trader desires. And with these structures, the downside risk doesn't necessarily need to increase proportionately to the upside either, given the asymmetric payoff profile of options. And when you couple all of that with high trading performance, as measured by the Sharpe ratio, for example, the prospective profits become very attractive indeed. So in the final part of the video, I talked you through some practical aspects of using this spreadsheet model yourselves with your own portfolio of assets so that you can make more informed decisions about your portfolio and have a greater understanding of its volatility or what you can expect its volatility to be, and also the correlations or potential risks in relationships between assets that you have in the portfolio. So that's it for this video. Well done, guys. You've come a long way in this video series so far, and I hope you've been enjoying it. That's the last video in this course that you'll be hearing from me, but I look forward to teaching you guys more in our other courses, and this is certainly going to be a really great step for you guys and point you in the right direction in terms of becoming better traders.